Hello, welcome to 2019. We are going to bring you a new model. It's an ATM business financial model, and this is smarthelping.com. So, it's been a while since I've actually done a full industry-based model, and this was a really cool one. I've been looking for one for a couple weeks to do, and I finally found a good one. So the ATM business is pretty interesting. There's not really any barriers to entry. You just need some capital to buy some ATM machines, and you've got to have connections and be good at you know, pitching your deal to different merchants. So the high level view of how it works is if you're gonna do this, you go out, you either look at a franchise that sells machines, and they'll probably take a franchise fee, or you look at just ATM processor producers that make these. You buy them and you set up deals with merchants to put ATMs at their locations, and you collect, fees on all the transactions of the ATM. There's not too much you got to do with regulation as long as you've got a nice ATM processor. I think they help with a lot of the logistics of everything and keeping everybody protected. Um, but there's a lot of interesting things we can do as far as modeling this, and I've done a lot of dynamic logic here. You're going to see is really cool. To get, we've got debt, we've got equity, we've got dynamic depreciation that looks at useful life, the timing of purchases of machines, the value of them. We've got dynamic tax calculations. It gets really, really smart. The model's really good. So I'm gonna just go through every single tab, explain what it does, and then by the end of it, you'll have an idea of how this works and if you want to use it. So let's get into it. We've got the first tab, control. So you've got the start year. This is just going to be for timing assumptions. The model will go out for up to 10 years and it goes by month, and then you've got also annual summaries. So you put your start year in here. It's always going to be the first day of the year. So 1/1 in whatever year you plan to start. You got your exit month. So, you know, you don't have to exit if you don't want to see that cash flow. You can just put NA and that's fine. But for valuation purposes, usually you'll have some exit month, and then you have an or an exit multiple based on the value of the annualized revenue of that month. So that's what you put in here. You can see you change this, it'll change to the valuation of that dynamically. We've got growth of transaction fee per year. So this is another global assumption. It's just because we're going out 10 years, there is, inflation effects. So, you might start your fee at $3 and grow it at 1% on average per year. But you might not grow it every year, but from year 1 to year 10 is probably going to have a higher fee, um, or it should. So this allows you to account for that, or if you don't want to at all, you could put 0% there, and that's fine. We just put 1% in for now. Active days per month is just an assumption to help drive the revenue calculation. And then we get into some debt and equity. So this is going to flow through the model, and then based on, so with debt, you obviously cover some of your upfront costs, but then you've got debt service over time. So this will affect the total equity needed, which is our next cell here, total equity needed after debt. So you can see this is going to go up if we put debt to 0. You can see 572. Uh, and this is based on your lowest cash position over the 10-year period. So it accounts, it's not just the startup, because oftentimes if you're doing this, you might buy, you have startup costs in the first few months or before you even start. But then if you scale out and start building, you want to build more machines over time, um, then that cash outlay is going to happen, it could happen over a couple years. So based on when that happens and your expected projections of revenues that you've made during that time, and your expected costs and everything else, you need to know what your minimum cash cash position gets to, and based on that minimum, we can derive a minimum equity amount. And this means your true cash position never goes below zero, assuming all the assumptions happen. And so that's what this equity amount is. So you can see, put this back up to 250,000. So if this is 353, it means between the owner and investors, or just the owner or all investors, you're going to need 200,000 from investors, 153 from owners over the life of the whole project. Now you can see if we go to our monthly, it's going to show you, we got all our logic here, the actual cash position. So this is accounting for um, the actual cash in the bank. It's going to go to exactly zero here. You can see by May of 21, and that is the lowest. That's where the lowest cash position happened. And then from there you're up, and you're never at an actual below zero. So that's what that equity filler does. And to help, um, that you could also put in reserves, like in your startup cost. You could say, well, if I want a $500,000 reserve, you don't need that much, but let's say to 20,000. That will account for all the costs, and it will mean that, assuming all your assumptions happen the way you think they will, you'll still have this extra 20,000 in the bank. So there's a lot of ways you can account for um, your strategic planning here. All right, so we've got our funding methods all here. Now for investor, you can give them a share of the profits, and based on that share, you've got an implied valuation. So if they give you 200,000, let's say you give them 10%, that's going to give you a $2 million valuation. Let's say 5% of the share, that you're giving a $4 million valuation. So that you got to work out with the investors. Obviously, you want the most money for the least amount of the company you're giving up if you are going to investors. And then the remainder, so assuming if that still doesn't cover all of the equity, you can see here you still need 153,000. Now this could be zero if you get all investors. Let's say, so let's see, that'd be 353,050. If you got it all from investors, it means you didn't have to put anything in, but you're still, whatever share you give them, you're going to get the rest. So if it's, 40%, you know, you didn't have to put in anything. You've got enough debt and investor funding to where you didn't have to invest any money of your own money. You're still getting 60% of any profit made. So again, this is really good for strategic planning, knowing what the expected cash flows are, and then you've got your debt and equity fillers here. 59% debt, 41%, or 59% equity, 41% debt. These are all automatic, and this is based on your total um, amount of money you're going to need upfront to cover everything. Okay, so now the fun part. Here's your revenue deals, and I've made this super dynamic. So you've got tranches here, and you've got the month each round happens, and each round is supposed to represent a different deal that you've done, or a different like round of putting in the ATMs. So let's say here, January 19, we're going to put in ATMs. The transaction fee is going to be $3. In that location, the average transactions per day is 10. Now, location is a huge deal with this. You have to have good locations. Obviously, the more people, the more money you can make, the more people using the ATM. So it's possible that depending on the location that you're putting the transactions per day could vary. So we need to account for that on every single different round, and that does this. And this will all flow through to the P&L. So transactions per day, the merchant share. So this is your share that you're giving to whatever location you're at. And then how many you're actually going to buy at that, in this round of building. The cost per machine, because that could also vary on every round. Total cost, total machines, and then sales tax if applicable. This probably won't be, but I'm not sure, so I just put it in here in case. If whatever state you're in requires you to collect a sales tax, that is here, and that's not included in the actual fee itself. That's separate. So you'd collect that, and or I mean, you would have to pay that out of your total revenue. So we have to build a matrix to account for all this stuff. So here's our fee matrix. It has so the first set shows you the raise in fees based on our 1% up here. So the 1% growth in transaction fee. And every single month, which is just based on it's just based on each tranche, whatever month you put in here, we'll have based on the month you have it starting. You can see January obviously starts in January. May doesn't start till May, so it looks at starting whenever you start that round, and then it grows the transaction fee every month because we've converted the annual rate into a monthly rate here, and we've converted so you're growing your transaction fee on average 1% per year by doing your compounded monthly rate of this, and that is flowing through every month dynamically based on whenever you actually start with that machine. So that's the first part of the dynamic summary. We've got transactions per month, so obviously that's another thing that's going to vary, and we need to differentiate between um, each round, how many transactions each round has, because there's different revenue or transaction fees. There, right now it's all $3 for, well, here's the 250. So I did vary it because this could vary. In some locations it might be 250, some might be $5. So in order, because that is different, we have to know how many transactions are happening in each set of machine build out or each tranche. So that is now, and same with sales tax. We have to do the same thing. So sales tax um, is going to look at each round and give you the dollar amount per tranche. And this is all based on, so you can see we've got the column K we're targeting, which is a sales tax, times the monthly P&L, which we've got in there is, I'm assuming that is going to be our total revenue. Yeah. So and you can see to figure out our total revenue, we have to do this big string. And what it's basically doing is we're referencing if it's not past the month of exit, and then we're saying if it's not, then multiply. You see we're doing revenue, we're doing column C, G, and E, and then the fee matrix B, and then times control D10, which is this is just the active days per month. So again, revenue C, G, and E, and then fee matrix B. So you can see if we go to revenue, that's the month, the amount of machines bought in that round, and then the transactions per day. And then D is the average fee per transaction. So C, G, and E. Now our fee matrix in B has got the total. You can see this is where we're referencing the fee because this changes. So we can't just reference column D here because this is going to change over time based on our percentage growth here per month. So we have to have a whole matrix for what the fee is per month or what the fee is per transaction of a given tranche over time. So that's what this does. And it flows into here so we can actually get revenue of each round. And then we can just add that up to get our total ATM revenue. And you can see how that grows over time based on adding machines dynamically. Now, if you want to see how it works, so let's just look at this. So we've got, let's say we don't start revenue until February, and let's say it's, um, so you see that'll change up. Now it's in start till February, and it's $4,500 a month. Let's change this to 5 transactions a day, so that should cut it in half. There you go, 2,200. So it did cut it in half. And then let's say it's $6 a transaction. So now it should double it back up. So there you go, back up to 45. So that all works dynamically. Um, really, really nice logic here, and this allows for the best possible strategic, um, business plan you can do for an ATM business. If you're going to do it, this is going to be the most accurate forecast. Okay, so next we've got, so that's the matrix of all our rounds. Let's see if there's else here. Oh, so I've also done depreciation dynamically, and that's just based on so this counts the number of months a given round of machines that you bought has been active, and then the depreciation looks at if it is greater than 0 months, so it has to basically is looking if it's between, um, 1 month active and whatever months you put in the running costs here for useful life. So if it's useful life for 5 years, that's 60 months. So this is just looking at 60 months, and it's going to depreciate because you've obviously got a tax effect there. So you can see count 60. So this is 60 months. It depreciates everything straight line. So the total cost divided by 60, and that's your monthly depreciation expense per tranche. And so that's a deductible, thing. So if we're going to calculate taxes, we need to know depreciation expense as well as interest expense, because those are going to come off of your EBITDA number in order to figure out your taxable income, and then that's going to affect your cash flow. So this is the first model I've done a dynamic depreciation number. I think it's, if you're going to get all the way down to the tax effects, you need it, and so it needs to be dynamic. You can't, it's going to be too hard to figure out what your depreciation expense is every month or year. So this does a nice job of figuring that out. Now you can see if we changed, running costs, let's say it was useful for 4 years, so now we should only see 48 here, and it's a higher amount per month. And there you see, yep, now only 48. So that's a very dynamic number there. Put it back to 5. And I think that's all I've got on the matrix. Yeah, that's it. So you can see the dynamic nature of what's going on here. Next is running costs. This is standard. It's mainly for general administrative costs. So you've got, just whatever it takes to run the business: legal, administrative, service workers, rent, general managers. If you're leasing machines and not buying them, you could account for that here, and any other regular monthly expenses. You can pick the month that it starts, and then based on that, it's going to flow through to the P&L, and this will be the monthly amount in each year. So you can change that over time, um, and it's all dynamic. We've got our franchise fee if applicable, so it might not be. If it's not, you can just put 0%, but if you are paying a franchise fee, you'd enter what that is there. We've got repairs and maintenance cost per machine, so this is another item, logic item, that flows to the P&L. And I thought this would be better to do rather than trying to figure out the monthly amount in each year. You can just make it a fixed dollar amount per year per machine and figure out what that average is, and it'll go. ATM processing fee. So this is if you've got agreements with ATM processor to help, keep everybody, um, out of danger or legal issues, everything else. They kind of make sure everything's going right. And for that, they usually charge you just a fee on every transaction. And I've put that as just an average, across the board. Then we've got income tax rate, whatever your effective rate is likely to be, you can put here. Um, and then it's also going to vary by country. And then you've got useful life for machines, which we've already been over. So there's your running costs. So now we've kind of talked about the control tab, all the global assumptions, debt, equity, how you're going to get funding. This the start of the business, the exit of it, how all the revenue works, how the fee matrix makes everything dynamic per tranche, the running costs. Then we have other startup costs. So this is just any other costs that you want to enter that happen before your first month. Just that you'll have to make some other initial investments. If you know what that is, you can put it here. If nothing, you can zero it out. And then CapEx is just like one-time expenses that you plan for happening in the future that's not going to count in the P&L, but is uh, just it could be a variety of things here that you might need to plan for that you don't want to hit EBITDA, but you want it to um, be counted in the cash flow to figure out, that will affect how much cash you need as well. Then we've got the debt schedule, which is just standard. The 250 is going from what you put on the control tab, and then the rest of these assumptions are entered right here. And based on that, you could see this flows just as a regular amortization schedule. And this is used to come through to the P&L and cash flow to make sure you've got the right amounts of principal and interest based on whenever this starts. And that's going to be also important for taxes. Now we've got visuals. So I've got a bunch of visuals: 10-year financial analysis, revenue, gross profit, EBITDA over time, an expense summary, the main expenses, cost of goods sold, general administrative, sales tax, total ATMs over time based on what you put on the revenue tab. You see here it grows up to about 170 something, 73 I think, and then levels off 76. Total transactions per month, that's going to grow with your revenue or with your ATM growth. Average number of transactions per ATM per month. So this is a number that you'll find between 100 and 300 from what I've researched. And so based on all the assumptions that you put on the revenue tab, you can see on average what you're doing per ATM per month. You've got your average EBITDA per transaction. So out of your transaction fee, this is how much you're earning on it. We've got your average fee per transaction. So you see it'll change based on your assumptions again, but that's a nice average. You got your monthly cash flow and accumulated cash. So you can see this is the running cash flow is not including obviously the startup funding, because that's what allows you to stay afloat. But this is what the startup funding amount looks at to figure out how much you need. So uh, the blue is what's happening every month. The running is what is the aggregate effect of that over time. Now this is your actual cash position, including like the initial funding. So you start up at 584, and then you can see you're going down because of these cash outlays that happen at the beginning. But we don't ever get below zero, as I've already showed you in the monthly. It gets close. In May of 2021, it's actually at zero, and then it starts going up. Gross profit per year, gross profit margin, and that's it for visuals. We've got distribution. So this is like we've got the deal level here. So this is what's happening before any cash is split between the investors and owners. Then you've got the discounted cash flow. This is actually project. So based on a discount rate, you can discount the future cash flows to get a present value and a net present value. The net present value just takes the present value of the future cash flows against the deal cash flow. And again, interesting thing is if you take the IRR and plug it into your discount rate, this will make the net present value zero, because that's the definition of it. And you can see there, project NPV goes to zero if you plug in the IRR to the discounted cash flow. And then we've actually got it broken down between the investor and owner based on the share you're giving up of the cash flows and the initial equity required from each pool. You can see what the internal rate of return is and the net present value for each of those. And again, a nice thing, you can plug in the IRR and see It'll put the NPV to 0. So it's a good check there. And this just shows cash flows happening at the high level and then how that's split between each based on this percentage share that we identified at the beginning. We've got the executive summary, which just shows what's happening to the project as far as total revenue, cost of goods sold, gross profit, your G&A expenses, sales tax, your total expenses, EBITDA, discounted cash, or I'm sorry, debt service coverage ratio here, based on if you're having any debt service, average EBITDA earned per ATM per year. So that's an interesting number, and it'll change based on all your revenue assumption figures. CapEx, debt service, these are all the other cash flow items. CapEx, debt service, ATM purchases. So you can see your purchases happen over time, and that's what affects your main equity requirement. Startup costs, loan proceeds. We've got the loan payback upon exit, which will happen whenever you put in the exit month. The loan payback will happen, and that will come off the exit proceeds. Um, you've got taxes, cash flow after taxes, running cash position, and actual cash position. Then we've got it broken down here between each. So you can see the equity required for the project, the total return, the equity required from the investor and owners, total return to each, their IRRs. We've got equity multiple, which if the equity multiple is below 1, that means you've actually not gotten back as much cash as you put in. And then the total investor and owner ROIs, as well as the projects. We've got break-even months here as well, month and year. We've got a break-even summary here that just shows the amount of, based on your fixed and variable cost, the amount of revenue you need to break even each year. We've got the monthly P&L. So this is your detail, that this is how we're deriving all those summaries. So the assumptions is going to drive that fee matrix, which flows into here. And we can figure out the total revenue, merchant fees, cost of goods sold, G&A expenses. We've got our EBITDA, CapEx, ATM purchases, startup costs, debt service. Now here is where we've got the depreciation coming in from that fee matrix, and this is where we're trying to figure out the actual taxable income, which is just turned out to be your EBITDA less interest, less or plus if there's an exit of the business, and then less the depreciation expense. So, and then we check to figure out if there's a taxable amount, and this checks if the sum of the year is above 0 for taxable income, which here it is 55,000. Then take the tax rate times the amount. Now, obviously, we can't pay a negative amount of taxes for a month, so all we do is say if this is less than 0, then 0. And that's, I didn't catch that when I first went through the model because I didn't have positive cash flows in the beginning month or year. Okay, so that adjusts everywhere. So we've got taxes dynamically happening if that year was overall the taxable income was above 0. And then cash flow after tax, so we can just easily fill in by taking the cash flow before less the taxes paid. Then we get our running cash flow balance, cash position, break even, and then all our other metrics here. The annual does the same thing as the monthly. It's just aggregating the monthly, as you can see. No issues here on the logic because it's just summing what happened in the monthly. There's a break-even year. So this is probably the most complete financial model I've ever done, and it's it's not super popular business ATM, but it's not too complex either. It's mainly a strategic thing. If you can get the deals going with the ATM, with the locations, and you've got the capital to do it, it's a decent returns. It'll obviously depend on all your running assumptions, running costs, and revenue assumptions. But this will allow you to plan basically any kind of way you need to plan and see the effects of that as far as the cash flow goes. So that's all I got for you. Obviously, you can go to smarthelping.com to pick it up, or one of my vendors, Eloquins or eFinancial Models, will have it as well. And it'll be $45 across the board. I think that's a fair price for what's gone into this and the value that it has. All right, and I will see you on the next one.